World Bank spending incentive alert and dangerous debt crisis could trigger recession and destroy decade earnings. Unprecedented government spending helped prevent a serious economic downturn in countries around the world. But the debt burden undertaken by governments like the United States to finance such stimulus measures could stall economic growth for years. The World Bank said on Tuesday experts are concerned that inflation could trigger another recession. The World Bank said in a report released Friday that global economic output, measured by global GDP, is expected to increase by 4% in 2021, pointing to an almost complete recovery in 2020 after the 4.3% contraction forced by the epidemic, poverty and almost stalled economic activity. The World Bank predicts slow growth of 3.8% in 2022, which could worsen if countries do not reinvest their assets to become less dependent on increased debt burdens. The cost of supporting the economy is high. The World Bank reported that global debt levels rose to 99% of estimated GDP for the first time in a record level last year, jumped up to 130% in the United States, largely as a result direct payments to individuals, unemployment insurance, and regional proportion of increased federal government spending on aid such as aid. Developed countries such as the World Bank and the USA have turned to incentive spending this year, but emerging and emerging markets such as Chad, Zambia, and Ecuador are among the most affected and most in need of assistance. World Bank President David Malpass says such nations are already unable to pay their debts, which could trigger humanitarian crises such as those facing Venezuela, where food and energy shortages have plagued the in-debt nation for years. The World Bank estimates that around 30% of the world's emerging and developing countries lose at least 10 years of earnings per inhabitant as a result of the pandemic, resulting in the decade-long growth losses they may face for these countries. Other countries began to borrow heavily when interest rates inevitably rose. Critical offer. The pandemic has made the rising debt wave even more dangerous. World Bank officials said on Monday, future debts, it is a red warning for some countries, Malpass added. Key history. In a note Monday about the consequences of massive government spending during the pandemic, Morgan Stanley equity strategists said rapid inflation and sudden interest rate increases that occurred quickly and without warning represent the greatest risk for the United States stock market this year. With global GDP output already returning to pre-pandemic levels and the economy not yet close to fully reopening, we think the risk of more acute price increases is greater than appreciated, said one of the authors, Michael J. Wilson. The rapid growth of Bitcoin and other cryptocurrencies. He points out that its rise is a sign that markets are already beginning to think that currencies such as the dollar could enter an unexpected collapse, they added. Tangent. The US federal government has authorized an unprecedented $3.5 trillion spending to support the economic recovery as a result of the pandemic. Big number. $27.8 trillion according to the US debt clock. The United States currently has approximately $84,000 national debt per citizen. The epidemic has put nearly $5 trillion in nation's debt. Amazing rail. The World Bank noted that the sharp decline in United States economic activity during the early days of the epidemic and the initial lockdowns in March and April were almost 3 times as bad as the peak drop during the global financial crisis in 2007. Stock market crash. Is this stock rally really resilient? A stock market crash can generally be defined as when a stock market drops about 10% in one day. the last time Dow Jones dropped over 10% was in March 2020. Since then, Dow Jones has built over 5% tanks only once. However, a stock market crash that could crush 12-month earnings for the Dow Jones and S&P 500 is likely to happen very soon. Here is the reason. Coronavirus mutation. The coronavirus is mutating, and new variants are more contagious than before, forcing lawmakers to implement more restrictive measures. The UK is back with a national isolation, which is the third national isolation since the coronavirus pandemic began. Of course, the United Kingdom is not the only country to experience a third wave of national isolation. We witnessed this in the Republic of Ireland and several other countries expanding their existing lockdown. Germany, the largest economy in the euro area, is struggling to keep control of the coronavirus, and we are likely to see a national lockdown there too. The most worrying factor is that the coronavirus situation in the United States is not getting better, and it is clear that Joe Biden, elected president, prioritizes public health first. So if we see a national isolation in the United States, the game could be over. The main cause of the stock market rally. The stock market rally we saw last year was mainly due to a faster than expected economic recovery in 2020. The US labor market has started to recover faster than many thought. The US unemployment rate dropped from double digits to single digits. As a result, stock traders took much more bullishness. In addition, the positive coronavirus vaccine news feed further strengthened the stock market rally. However, both of these factors lost weight. First warning for stock market rally. The US weekly unemployment claims are starting to show that the United States labor market is taking a wrong turn and more people are losing their jobs once again. Although yesterday's figure was better than expected, the actual 787,000 compared to the 798,000 forecast, the rebound in the labor market is not the same as it raises stocks and makes stock traders more optimistic about the stock market rally. The last US ADP employment number came at 123,000 against the 60,000 estimate, with the previous number being 304,000. Of course, this has been increasing for a while, and the weekly unemployment claims number is warning us about this. So, under the current circumstances, it will be really difficult for Dow to continue the huge bull run. Reality will catch up and the stock bubble will likely burst. Second warning for stock market rally. Vaccine distribution has increased more slowly than expected, and it seems likely it will take some time for a significant population to receive the first dose. Basically, the longer governments take to inoculate the population, the greater the uncertainty. We saw a small portion of this earlier this year, exactly on January the 4th, when Dow Jones stocks plummeted. Stock exchange and bankruptcy files. Another important factor that requires stock traders' attention is the number of bankruptcies occurring in the United States of America. This is really critical, and neglecting it catches stock traders off guard, which can lead to a stock crash. According to the Bloomberg, annual US bankruptcy filings in the 2020 rose to the highest number since 2009. Further lockdown or restrictive coronavirus measures will be weakened, as many companies can minimize the damage caused by the coronavirus outbreak by inflating their balance sheets with debt. They may have no choice but to file for bankruptcy, and this could lead to stock sales. As a result, summing up, I agree that optimism about further incentives is a chance to continue fueling the stock spike, but under the current circumstances, the chances of correcting the stock market crash before seeing another big bull run are higher. If you make any investment or legal decision, it is advised to consult an expert before making this decision.